Good morning, good afternoon, good evening. Welcome to the World Investment Forum and the Family Business Conference, co-hosted by FBN, the Family Business Network. My name is Alexis Duroy-Dubliqui, and I'm the CEO of FBN, and it's a great pleasure to welcome you today to our second session on how families and family offices can accelerate impact through their investments. We have a great panel today, which I'm going to introduce to you in a few minutes. And each of the panelists will share with us some of their insights on the work they've been doing, on the research they've been doing, and how themselves and their families are approaching this topic so that families can really accelerate the impact of their investments. Again, welcome. My name is Alexis Duroy, the CEO of the Family Business Network, and we're delighted to be a strategic partner of UNCTAD and the UN in this World Investment Forum for the first time. Really, for us at the Family Business Network, it's an opportunity to become more public, more vocal about what families are doing and how they can be game changer in this world of impact investing. Just to start the discussion in the session, I just want to share a few numbers with you. I think you've seen them, you're probably reading them in many reports or in the press, but and these date back from a few years, so they keep on increasing. There has been a report that almost $23 trillion of investments are being oriented broadly towards ESG policies. And out of that, we can say in the US that about 20% of investment on the management are broadly also oriented towards ESG policies. And 95% of institutional investors plan to engage with companies who are doing some work around the issue of sustainable development goals. So there's a trend, there's an accelerated trend, and we want to discuss that today in the session to see what's the role of family offices and families in that trend, and how can they really position themselves as a change agent in this sometimes broad and complex space of impact investing. As I said, we have a great panel. We will first hear from Alex Scott, who's a member of FBN, also a member of his own family, has been a very active leader of his family for many years, co-founder of their family office several years ago, which they sold now to another family, and continuing to work and operate as a family investor and an activist in the space. So welcome, Alex, and looking forward to your opening speech. We also have our partners at PwC, Peter English, who's the global lead of family business practice at PwC, and one of his colleagues, Bejan, who recently co-wrote a very interesting report on impact investing in family offices. We have from Singapore, Manish Tibrawal, who's the CEO of Maitri. Maitri is a fairly recent but already well-established family office from one of our member families based in Singapore, the Tolaram family. We have with us from Switzerland, Benjamin Firmenich from the well-known family business, who will share with us his own journey on impact investing and his own venture and his own entrepreneurial venture that he created several years ago, and how it resonates within his wider family. And finally, we have Peter Brock of 4L Vision, the CIO of 4L Vision, a very active investor, and also I would say even more than an investor, an activist, a very vocal activist in the space of impact investing. So welcome to all of you, the speakers and the panelists, and now I'll give the floor to Alex Scott, member of the FBN board, co-chair of our family office community and founder of Applerig. Alex.
Thank you, Alexi. Well, it's great to be here, and hello, everybody. About 6 months ago, my family went through some significant changes. One was to change the the generations. I was succeeded by a member and leaders of the next generation. So we've moved now from 4th to 5th generation in terms of owners. And the second was that we decided to change the way our liquid assets were managed. That gave us a period for reflection and thought. It meant that the next generation, the generation of inheritors and successors to my own, could give careful thought and reflection to the manner in which we invest our liquid capital. And this is a key point, because this session is about families and family offices, and the manner in which assets can be managed by a family office is clearly influenced by the underlying family. I call that sentient capital, by which I mean that the deployment of capital can be directly influenced by the beliefs and values of the underlying family. So we decided to use this appointment of Schroders to manage our assets to undertake a much more decisive and impactful approach to investment. So we met as a family. There are about 36 members of the next generation, and we have a governance process for that, to put together a statement representing our collective views. That's quite a challenge with a wide and disparate group of people, but actually we found remarkable coherence. I'm sure there'll be lots of different opinions on many different issues, and I know there are amongst my family, but in this case we found a strong degree of coherence. The whole theme of this conference and the whole theme of this session won't surprise you, that there was an alignment amongst all owners of assets about the need to invest thoughtfully and sustainably. But to bring together a disparate group to write a statement was, I think, a special opportunity and a special occasion for us. It's about 5 paragraphs long, and I think it's appropriate if I just read you the first 2. They're very short. So our statement of investment intent starts as follows. We wish to invest our capital in a manner that aligns with our collective values. We believe this will support and enhance our family's objective to be purposeful stewards. We welcome the UN's call to action on climate change and sustainable development, and want to use our capital both to deliver investment returns in line with our long-term financial objectives and promote a better future for people and planet. So we gave that mandate to our advisor, and I'm just briefly going to talk to you now about the outcomes and our experience and expectations going forward. So we can move forward 2 slides, please. So on the right-hand side there is simply a demonstration that we're in a period. It's exciting. We're in a period whereby the owners of capital can have impact, whereby we have the analytical tools to understand that impact, and we can apply our values to the way that we invest capital. I think this is a really exciting stage, whereas previously, as we know, the focus was on return, then we managed to understand risk. Now we can talk about impact as well. So moving on then, we can see now, we've asked our manager to produce a portfolio for our liquid assets for us. And the next slide gives an analysis of what we can expect as a family. I don't think there's much that will surprise people here, but I think it's the analysis and the ability to understand what our money is doing, which is most important to us as owners. So you can see across the top there, with 100% of the capital, we seek to avoid harm. What do we mean by that? We mean that we'll have no fossil fuels, no tobacco, no alcohol, armaments, high interest, lending, gambling, or pornography. It also means that we expect alignment with the Paris climate change policies, and that will be ESG integrated. As you can see, 3/4, 77%, will look to be benefiting society in some way or other. by which we mean we'll be investing in sustainable leadership companies. And finally, we'll be able to understand the way in which we're making a positive contribution. You can see on the left-hand side there that we're able to analyze the portfolio in the context of the degree to which it's aligning with the SDGs. You can read those for yourselves, but the thematic alignment on the right-hand side outlines this, that we will be contributing to solutions under climate change, infrastructure, consumption, health and well-being, and inclusion. So this ability for the inheriting generation to understand what their wealth is doing, how it's having an impact, and how it's addressing the very critical challenges that our world faces have been a major step forward for us as a family, and in terms of engaging the next generation of inheritors. It's absolutely critical from my perspective as someone who's responsible for handing an asset on intact, to be a purposeful steward, that they want to inherit this. And by undertaking this analysis and these actions and deployment, we can engage the generation of inheritors very specifically with the assets that they own. Moving on to the next slide, then we can just dig a little deeper and see. So the data here gives an analysis of what we will have, because these are the proposals that have come back to us from our manager Schroders, to what we would have if we invested in the MSCI. So you can see that there's a dramatic reduction in the carbon footprint of the companies that we'll be investing in. There's a significant increase in social benefit. You can see that we'll be contributing to the provision of medicines, fair wages, connectivity, innovation, and our sustainable portfolio will be relatively producing substantially less carbon, using less energy, or the equivalent of removing cars and growing trees. So that is an introduction to what follows, is a short explanation of an important beginning of a journey for my family. Thank you.
Thank you very much. Thank you very much, Alex, for these opening words, and to see how already you're projecting yourself in the future with the impact that you will have. Now, it's my pleasure to give the floor to our partners and colleagues and friends at PwC, Tom and Peter.
Thank you, Alexis. So first of all, introduction-wise, my name is Tom Beechant, and I lead the work that we do at PwC around impact investing. I'm going to cover off a few areas. One is, what do I mean by impact investing? What is investing for impact? Why is investing for impact just good investing? And then look at perhaps some of the challenges that exist with this, not least of all measuring the actual impact that Alex has just been talking about. So Alexis, if you can move us forward to the next slide, thank you. So what do we mean by investing for impact? This diagram is what's called the spectrum of capital, and it sets out a variety of different investment approaches and how they link to impact. What's very clear from this spectrum for me is that investing for impact does not mean you have to have some investments which are focused on providing a return and a separate set of investments that are focused on delivering an impact. You can have both together. This spectrum talks about everything from traditional investing on the very far left-hand side, which is where there's no consideration necessarily of ESG or impact, all the way through different degrees of consideration of impact. Some of these aligned with what Alex has just been talking about in terms of avoiding harm, benefiting stakeholders, and contributing to solutions. And recognizing even when you're in a world of contributing to solutions, you can have everything that is financial return first, all the way through to impact first as a return. And then moving all the way to the right-hand side on here, looking at philanthropy as a whole. So investments made with the intention to generate positive, measurable social and environmental impact alongside financial return is what investing for impact is all about. You can move to the next slide. But why is having an investment-focused strategy really important? Well, we live in a world at the moment where we've got quite a lot of disruption, urgent, interdependent and accelerating forces affecting business today, many of which of these can be classified under ESG. For example, climate, rising inequality, resource scarcity. Businesses which respond to these forces are the businesses which will thrive and survive, and businesses that don't, won't. So investors that can spot the businesses that will thrive and survive will get better financial returns. Therefore, investing for impact is just good investing. Not taking these factors into account, therefore, one could say is bad investing. Don't take my word for it. If we look at the graphs on the right-hand side of this slide, the chart at the top looks at the outperformance of energy companies which have pivoted away from fossil fuels over the last few years. And there's a clear differentiation in terms of their share price performance for those that have shifted away from fossil fuels compared to those that haven't. The graph on the bottom, it's a little bit more nuanced in its colours, is focused around businesses where they've got a large proportion of their products which can be determined as green. So the revenues from their products and services are green. You can see that those that do that have outperformed over the last few years. There's more. If you move on to the next slide. On the left-hand side is a chart that's looking at charting disclosure of information around ESG, clearly showing that companies that are focused on ESG and have disclosed transparently about what they're doing to manage their ESG risks and opportunities have outperformed those that haven't. Equally, on the right-hand side, companies that have been rated for strong ESG performance over the years by, in this case, some examples of some of the ESG raters, have also outperformed the market in general over this period of time. So the evidence base is really there these days to demonstrate that investing with ESG and impact in mind can lead to outperformance in terms of returns. But, and Alex, if you move to the next slide, not everything to do with this is straightforward. How do you go about identifying those businesses which are most likely to outperform as a result of the way that they manage risks and opportunities associated with ESG? So bringing impact measurement on a par with financials is what's needed to get us to that place. We're a bit of a way away from that at the moment. What I've got presented here is just an example of the use of PwC's Total Impact Measurement and Management Framework, which looks at putting a monetary value on the scale of positive and negative impacts of different organisations. The chart on the left, green is positive impacts, red is negative impacts, and it's looking at a typical auto manufacturer. And it's looking at some of the positive benefits that auto businesses bring, such as mobility, provision of jobs, wages, contribution of taxes. But that comes at a cost with some of the negative impacts associated with perhaps the greenhouse gas from internal combustion engines or road traffic accidents. And the chart on the right-hand side focuses on a deep dive into some of those negative impacts, everything from particulate matter that comes out of a tailpipe all the way through to some of those road traffic deaths on the social side. So you can see that a traditional internal combustion engine auto manufacturer has a balance of green positive impacts, but also a number of red negative impacts. An auto manufacturer that can therefore move towards two things. One, electric vehicles can eliminate a large number of the negative impacts associated with the combustion of fossil fuels, but equally autonomous driving and the potential that has, when we get it right, to start to reduce road traffic accidents and deaths associated with it. The more information we have from companies that can help us understand which ones are making these transitions, the better place we will be to identify some of those areas. So if we do understand each investment and how it creates and destroys value for society in the way that these images on the screen at the moment do, we will be in a better position to spot the businesses which are most likely to thrive and survive, and not be stuck with those that ultimately will wither and die. So I'm going to hand over now to Peter. What does all this mean for family and family offices?
Many thanks, Tom, and also welcome from my end. So what we heard so far clearly indicates that there's a shift in the paradigm. In the past, we often heard that you can have profit or purpose. And the way how many of the successful families with a business try to give back is through philanthropy. Or in other words, I would like to quote Andre Hoffman from the last year FBN Global Conference. In the past, family business often tried to mitigate the damage that they caused with the business through philanthropy. And this has totally changed. And this has changed into the new idea of that profit and purpose has to go hand in hand. Larry Fink from BlackRock stated in his last message to the CEO in 2021 that climate risk is investment risk. We currently see that if you don't adhere to ESG goals, if you don't try to combine profit and purpose, this has different negative aspects, not only on your company evaluation, not only on your ability to attract and retain the best talents, also on your day-to-day business, including the way how you'll be able to refinance the business. And look where the pressure is coming from. It's coming from a new generation with a different mindset. Fridays for Future is just one example how the users are expressing the new ideas and the mindset. It's also coming from regulators, EU Green Deal, EU new taxonomy. This has a massive and very tangible impact on the way how companies need to run their business and their ability to attract talents and investors. For a family business, and this is what we see on the next slide, there's an additional layer of complexity, because in families, you have to deal with the alignment across generation. And I'm so glad that Alex outlined in his first opening here that they spent a lot of effort to align amongst family members across generation to what kind of values and family mission they want to agree. And this should be codified in clearly defined values for the families. Often this is nicely converted into a family charter and family protocol. And often it should be translated also in a mission and vision for the business, code of conduct, business strategy, and good corporate governance. But nevertheless, and if you look at the results of the last global PwC family business survey in collaboration with FBN, which we launched earlier this year, we see there's still a gap to close. More than 80% say, yes, we are willing to make a positive contribution on ESG, SDGs, and we as family business need to lead the way. But there's still not on the top of their strategic agenda. It's still amongst the priorities, but not a top priority. So there's a gap to close. So, but it's not only true when it comes to the way how families running their business. It's also true, and this is bridging to the topic of our session today, how they invest their money. And there's even more education needed. There's even more questions that left to the principals and the family office executives. And these questions, these are those that we have outlined in our Impact Investing for Family Office guide. You see a visual here. Please do not hesitate to look at our website to find more on this one. But what I would like to share is, and this is why I have here this red arrows here. So we see still very, very rarely that there is really a clear investment guidelines, similar to what we heard from Alex, for many families. There is still a strong focus on profitability and maximizing profit in the different asset classes. The balance between profit and purpose is not often discussed, nor translated in clear investment guidance for the investment managers, whether it's for the liquid assets, for the direct investments, or other asset classes. And it should also be aligned with the way how families want to give back to society through philanthropy, because I think the concept of philanthropy is still not dead, it's still alive, and families see that as often as a great opportunity to engage family members in different ways. And therefore, for the time being, I think philanthropy is necessary and important. Looking forward in an ideal situation, I personally believe the more business orient themselves towards ESG performance, and the more the wealth is invested in a more responsible ESG focused way, the less philanthropy is needed. And this is what we also clearly see in the different parts of the world. According to our finding with the Family Business Survey, we see that in the Anglo-Saxon environment and in Europe, we have still a strong focus on performance and a strong commitment to philanthropy. Whereas in Asia, we have much more focus on embedding ESG and sustainability goals in the investment strategy and in the corporate strategy for the business. So this all is telling us that there's a shift in paradigm. And on the left-hand side, you see what's needed. It's needed that families and the shareholders align and agree on what's important for them, that they have the strategy and the mission statement and cohesion in what they want to achieve together and as individuals. And this is a discussion which is super important if you think about the different perspectives of the different generations. And we will also hear later on from Benjamin how in their family business, the different views of generation have developed new solutions. But I believe without having this transgenerational discussion, with not having the alignment, family businesses create a disadvantage, and they should have an advantage because they are still the most trusted form of organization, as we know from the Edelman Trust Barometer. We need family business not only for job creation, but also for innovation. And this is why investing family wealth through a family office into the right channels is super important. But it can only achieve the maximum impact if it's all aligned and not random action. So alignment is key. Don't forget the principles. Don't forget to translate this in clear mandate for the chief investment officers and family officers. And then I'm pretty confident that this will create a super big impact and that the world is waiting for, basically. And on that happy note, I would pass it to the next speaker.
Thank you. Thank you very much, Tom and Peter, for helping us to understand that as families start to think and act beyond their legacy business and businesses, that the need for alignment is essential, because when you're around a legacy business, you have it in your DNA. While you're moving towards investment, it's harder sometimes to keep the family together, and it takes time and effort and energy. And the evidence is there, as you've shown it, but it's important to look at how we measure it, how we approach it, and to be very systematic in that impact investing approach. Now we're going to hear from 3 examples. And Peter, you were talking about Asia and how many families in Asia are actually moving into that space, but really from the purpose and from the alignment of the values of the family and their investment practices. And we'll hear from Manish Tibrewal, Maitri Asset Management Company of the Tollerheim family. Manish, the floor is yours.
Hello, everyone. I'm super excited to be speaking at the World Investment Forum, and I'm glad to see such a large interest in learning about families' journeys into impact investing. So if you just move on. A bit about ourselves. So we are a certified B Corporation. We take pride in being the first multifamily office in Asia Pacific to be certified B Corp. We are also a signatory of PRI, TCFD, Singapore Stewardship Principles, Net Zero Asset Managers Initiative, Climate Action 100+, and AIGCC. And without the association with FBN, I wouldn't have been here in this forum speaking to you guys. So a big shout out to the FBN community. And moving on, a bit about our journey. So we are a 4th generation family owned but professionally run business. It all started in 1948 in a small tailoring shop on the eastern side of Indonesia, a small town called Malang, where our current chairman's father, Mr. Kanchan Vaswani, started this business. And he named the business after his own dad, whose name was Seth Tolaram, after whom the family and the group is named, who was actually a physician and who would treat people free of cost. So giving back to the society has been in the DNA of the family since many generations. And after that, there was an evolution and expansion phase for the family. Our chairman moved to Singapore in 60s. We expanded globally, mostly into emerging economies, Africa and Asia being at the forefront of our operating assets. And as part of that, we have impacted millions of lives directly and indirectly. And the new era was in 2015, where as part of major restructuring of the family holding, the Ishq Tolaram Foundation was created, which is the single largest beneficiary of the whole business as well as family office. So every dollar we earn, 25 cents go to the Ishq Tolaram Foundation. And at the same time, Maitri in its single family office version was established in 2015. If you can move to the next slide. Now let me talk about our responsible investment approach. So I think Tom covered this earlier, so it's pretty similar to what he was also mentioning. So for our family office money, we look for market competitive returns while having impact. So it is possible to align purpose with profit. It's not either or for us. Having said that, we do manage our foundation and now some other mandates as well as being a part of multifamily office. And we do run some impact first or thematic mandates as well, where the impact could be, girls' education or reducing the waste or reducing the carbon footprint or financial inclusion. But here I'm going to primarily talk about what our family offices prop money is deployed into. Moving on to the next slide. So before we get into that, let's remind ourselves on the long-term risk. So this is a chart adapted from the World Economic Forum Global Risk Report, where you can see that infectious disease has been ranked much lower than a lot of other environmental risks. And if we look at the same chart in 2019, actually infectious disease was even much lower. It's only updated after the COVID impact. So we can imagine what could happen if something happens on the environmental front, especially the climate action failure. And I mean, there's no plan B for that because there's no planet B, right? So the time is to act now, especially on the environmental front. So we follow a two-tiered approach. The first is the negative list or the exclusions. So we have broadly 7 exclusions: adult entertainment, alcohol, recreational cannabis, gambling, tobacco, weapons, and coal. And then we have our second tier of responsible approach, which is covered in the next slide. So in the next, in the in-house approach, what we do is after all the investments go through our negative screening, we identify the risky sectors. We look at ESG scores of all the companies. We see what controversies these companies have been involved in. We monitor these companies all the time. And then we also engage with these companies and vote on relevant matters, especially on the transitory companies, right? Because especially in Asia, a lot of companies don't even have basic awareness around sustainability or ESG. If I write to some companies in China or Indonesia, they will ask, what is ESG? We don't know, but we would like to learn about it. So we are actually holding hands of these kind of companies in transitioning because we believe that the delta there or the difference there would be much bigger than the companies who are already at the forefront of ESG investing. So we can't leave these companies behind, and rather we should be engaging and encouraging them to be a part of us. And on the chart that you see on the right side has been taken from The Economist, and which shows the lack of data, right? So 2 leading service providers the same company, one service provider can rate it very highly on an ESG score, whereas the other one rates it very poorly. And that is why we have a dedicated ESG team in-house to actually evaluate those companies and look beyond the scores provided by the data providers. So we focus on 5 major investment areas. So being a family office, we don't need to think in terms of quarters, but we can think in terms of decades. So we have identified these 5 themes as the themes for the next decade, so to speak, which will give us outsized return, but at the same time have a great deal of impact on the sustainable development goals. It starts with climate change. We have all talked about it a lot, and we saw in the risk report as well that it is the single largest risk that the world is facing at the moment, and this is an irreversible damage. So we really need to focus on that, and there are a lot of very innovative clean tech, green tech companies evolving in this area. The second one is aging population. So as per the UN report, the population above 65 years of age will double from 750 million to 1.5 billion in the next 20 years. We have seen how COVID impacts the most to the elderly, and increasingly that will happen. So good health and well-being, which is SDG 3, is important for all age brackets, but more so for the older generation. Talking of cybersecurity, the loss due to cybercrime has increased drastically because of COVID and because of moving online, from $500 billion in 2018 to close to $1 trillion by the end of last year, which is 2020. So again, that becomes a very key area where a lot of investments are needed. 5G is a very important pillar of the 4th industrial revolution. Again, we saw what COVID did to the world and how technology helped us. So if not for work from home and enabling of technology-enabled work from home, probably the job losses would have been manifold, and the impact on economy would have been a lot more pronounced. So as we move towards 5G, towards autonomous driving, and towards more cleaner ways of conducting things, this will give us a good impetus. And then millennial behavior. So, and when I say millennial, it includes Gen Z. We all know that how woke is the newer generation in terms of their lifestyle and their conduct. They may not want material possessions, but they want to live sustainably. They put a lot of impetus on how things are being sourced, what is the supply chain of any product that they buy, and that's driving the new ways of consumption and new ways of companies marketing their products. So this is what we focus on. Doesn't mean that we don't focus on other areas, but we think that if we focus our energies on few areas, and if we are able to make impact in a bigger way on few areas, that's a better way than spreading ourselves too thin and trying to achieve everything. Thank you so much. Back to you, Alexis.
Thank you very much, Manish, for reminding us that this project, which is very recent, is really rooted in the values of the family that started several generations ago, and that the value of the founding father is trickling down to this generation, and with a pretty significant capital allocation to the foundation to allow for this to happen. Thank you also for sharing with us how you have started from a negative list to a much more proactive way of looking at things with your own team, and really, as you are moving beyond the legacy business, managing the assets in a way which are aligned with the family values. Now we're going to hear from, you mentioned the new generation. We're going to hear from one of them, from the Firmenich family, Benjamin. He's going to talk about his own personal journey first, and how then it resonated with the rest of the family and with his own entrepreneurial venture and project to bring impact and to invest in an impactful manner. Benjamin, the floor is yours.
Thank you, Alexis. Hello, everyone. I'm really glad to be here today, invited by FBN and UNCTAD. So about next gens, I think that's something annoying when you are being told you're a next gen. It's like in French, you say fils à papa, right? So my definition of next gen is everyone is a next gen except the founder. So if you ask me, my dad, he's 77, he's a next gen. My grandfather would be 115 years old. He's a next gen. So I believe there's a founder and all the other coming after him in the family are next gens. That's first thing. Now, I've been in impact investing for 10 years now. So I'm an old next gen in the next gen definition that you are not the next gen after 40, or it depends on the definition, but this is for you that are not in family businesses here today, it's a burning subject with families. I used to go to conferences and show a picture. Alexi, you can move forward, of my grandfather, and saying, look, that's what my grandfather used to do when he traveled abroad. He went to Africa and he went elephant hunting. And that's me when I travel. Look, I'm in Peru with entrepreneurs, and here's my colleague Fabian with a pink shirt, and I have investors with me. My parents came with me, and also a member of the board, and my sister is there. So I used to reject my grandfather's in doing and my grandfather's values. And after the years, it started changing. These last years, I'm more interested in what my grandfather does, what he did. And actually, he's inspiring me for lots of things that he did. And he was the one who started doing a profit redistribution in the company in the 50s. And everyone in the company, every quarter, could see a presentation of the results and also would get a prime based on the net profit of the company. And in the 70s, our company defined fundamentals, Firmenich. And since then, we already said in the 70s that we want to be an example, ethical, moral person. We want to be the best in terms of respecting rights, environmental protections, health and safety. And that's really the legacy. That's what I'm taking from my grandfather. Yesterday, I was discussing with my dad about that, asking him, you know, when grandpa went hunting in Africa, and he told me, yes, that was in the 50s, but he came back to Africa after, but he didn't want to hunt. His friends apparently wanted to continue hunting, but he wanted to make a video, and he made a film on a safari. So again, I was reassured, like, okay, my grandfather was not such an asshole like I thought. And I think this is really the key message, if I can say today, is that we're not reinventing the wheel. What we do is we take the best from our ancestors. And I think if we have family businesses that are thriving, that are still there today, there are very few family businesses that pass the bar of the third generation, right, Alexi? I think something like 90% fail.
Yes, that's what we call the dark statistics.
Yes. So you are from family businesses, and there is always good things to take from our ancestors. And it's also the same in every problem that we are facing today. That's I think my message, because we have the tendency, I find these days, of seeing problems and then saying, okay, we'll work on a solution and we'll provide solution to this problem with a whole new way of doing things. But actually, we have so much wisdom in our past with our grandfathers or our ancestors that what I do today, this investment, is just applying what my grandfather used to do in the family business to the portfolio. And in Peru, we were visiting that scallop farming operation, and it's also a family business. That's interesting. Most of the companies that we finance are family businesses. You can see there are two brothers the other one with no hair, and the other one, the tallest guy next to me. And these guys, they were passionate about the sea, and their dad had a plastic manufacturing company that he sold, and they went into the industry of scallop farming and started their own operation in having their hatchery and producing life in their plant of those shells, and then injecting life to the sea. And so it's really something I wanted to say, and also sharing on what families do, and families that want to do impact investing. I would advise them to be careful that defining your value is something, I'm sure you have them, okay, you can work with a consultant to define your values, but most of the time we all agree that values is ethics, and it's not, I don't know, robbery, or that we want to care for the planet. So, I mean, this is an exercise, but be careful not to get burnt by being too passionate or too emotional about your investments, because it's just doing investments. It's the same. We do investments. It's very complex. It's hard to beat the benchmark or to beat other investors. And on top of it, you're adding a layer of ESG, a layer of impact, that you want to have a positive impact. So look what's around, look what is successful, what resonates with your legacy and your opinion of business, where business is good. And there are some funds out there that do really good job and have a great performance. But I think also that's one of my tips is it's very serious investing, and governance is key in that. And what I see, because we talked about philanthropy before, and one of the question was philanthropy, how do you connect philanthropy to the business activity of the company, of the family business? So there is strategic philanthropy. There is companies that invest in their value chain or the research project, and then it brings product or ideas to the business. But what I see in philanthropy, and just the other day, I had a cousin coming to my family gathering and presenting what he does in philanthropy. And one of my questions was, hey, Antoine, it's great, but why don't you work together with the family foundation? And he said, yeah, well, I thought of it. I know, maybe I don't remember he thought about it, but he said, you know, we want to take fast decisions here, and we want to act fast. And basically, he didn't want to present to others or to have the acceptance of others. And that's because I find sometimes philanthropy is very personal, and it's the issues that you think are important that you address. Of course, it's great, and we need philanthropy. I think we need it. Peter said we would less need it. I think we need always and always more philanthropy. But you need also to be challenged. And that's the problem sometimes with families. They do things on their own little projects, their own little philanthropy or foundation. And everyone's saying, oh, it's so nice, bravo. But no one's there to challenge them. And what I like with what I do is that because I bring institutional investors in, they challenge my impact. They challenge our methodology, our strategy. They say, look, that's biodiversity indicator. What is this? 1,000 species coming back. Please demonstrate it or prove it. And then I think every year of how to better report on impact. And this is, I find it's key, is to have peers around you and do things together, unite. There is a family specialized in that. You go with them, you trust them, and you follow. There's intuition that is there. There was a remark on LinkedIn about today that we are on a manel, right? There's no female on our panel. That's sad, but yeah, that happens. But about female, and I think what we tend to forget with impact investing, we are obsessed with measurement and data, and we're applying some concepts of finance that is very metrical. But at the end, we have to work with our intuition and our guts too, and that's what we say in French, intuition féminine, right? It's more our female part personality. And so our guts always are true, right? Then we have to, of course, the rigor after. I made some terrible investments just following my guts. So don't just follow your emotion, but listen to them and then use the best way to due diligence in a very professional way, the best advisor, or you get trained. And that's what the messages I wanted to pass today.
Thank you very much, Benjamin, for such for sharing with passion your journey and what started your impact investing and impact finance journey started with a rejection of what you believe are the wrong family values, and then as you grew and developed, you really realized that there was this need to better understand, to align, and to come through what we always like to quote at FBN, which is this African proverb. It's another way to look at Africa. If you want to go fast, go alone. If you want to go far, go together. And I think that's what we're trying to demonstrate also here with this session, is that learning from other families, learning from families that are coming together in this new way of looking at investing with impact is fundamental to do the right thing, to work and invest with passion, but also looking at the right formats, the right investment practices to have the impact that you desire. Now, we're going to learn on that in a very pragmatic way from Peter Brock, who's the CIO from 4L Vision, on how this family has sort of put in practice in a very pragmatic way its approach. And Peter is not only a CIO and an investor of a family office, successful one, but he's also an activist in the impact investing space. So Peter, the floor is yours.
Yes, thank you, Alexi, thank you, FBN, and also UNCTAD to put this great panel together. It's a nice flow of people, one after the other. I can only stress Alex, Scott's initial comments, and if you go on the first page, Alexi, but also Benjamin Firmenich's comments just now, where he said, invest with passion. That's for sure, that's correct. But let's make sure that impact investing as an investing philosophy actually works by applying the traditional good concepts of investing. I show you here the pyramid of investing, risk, return, liquidity. Alex showed something similar in the beginning. And now with impact investing, we add to that the SDGs to achieve really deep and honest impact. So now at 4L Vision, that's a single family office in Germany, actually with one wealth owner. It's a very small family at this stage because he just sold his IT company only a few years ago. And the wealth owner decided really to be very keen to invest in something good. He just didn't want to stick to the old habits, and he decided to invest with impact. So I'll show you in a minute the portfolio of the single family office on the direct investment side. But then for the liquid investments, he also decided to simply acquire his asset manager. And we created a new family office from it, a multi-family office called 4L Capital, in order to attract more people's capital into impact with the thought of democratizing impact investing, and do that in all asset classes, because impact investing isn't an asset class in itself. It can be applied in all asset classes, even in real estate with social housing projects and so on, surely in liquid equity investments and also in private equity. And we have the freedom in the single family office to do no greenwashing or no impact washing. So what we choose is a very strict concept, which I show you in a minute. But if you go to the next page, so, we hate greenwashing. And this is our direct investment portfolio. You see, we have over 20 investments, some small, some big, in vegetarian muesli bars, lots of different things, in insulation companies, in a battery company, electric scooters, in private equity direct investments, you can probably achieve the highest impact directly with the additionality that impact requires. But then on the top left, you see this 4L Capital. That is the multifamily office where we do liquid investing in a global equities portfolio. And, you know, we always differentiate between liquid assets and illiquid assets. You know, whilst on the liquid side, we believe an equity portfolio should be part of an impact portfolio and is definitely part of a good wealth management strategy, but it's sometimes questioned whether or not the impact is very high that you can achieve there, but I'll come to that in a moment. So next page, indeed. Now, very, very briefly on this, our principles, why are we called 4L, the 4L impact family? It's simply along the lines of the American author Stephen Covey, who said, live, love, learn, and leave a legacy. So these are the main demands in life that we follow with all that we do. And we are building a family around 4L Vision, the single family office, 4L Capital, the multifamily office. There is a law firm linked to us, which we will soon call 4L Legal, and so on and so on. In Germany, we support the infrastructure, we support the impact investing federal initiative. We have a platform called the Impact Investing Magazine. So we are building a whole bunch of followers around us. Now, if you go to the page on 4L Capital. So I said 4L Vision is the direct investments with a very high and measurable impact. 4L Vision is the direct invest. 4L Capital is the liquid asset management, where we focus on a global listed equities portfolio, which is hand-picked by us. It tend to be some 40 to 60 stocks that are at any one time in the portfolio, mainly small and mid-cap companies. But we also, apart from this portfolio, we also do the normal strategic asset allocation. So we help other families to get into impact. And that is the reason why the wealth owner, Ralph Zuikat, by the way, why he simply acquired his asset manager in order to share these opportunities with others, because very often the argument is mentioned that there are not enough investment opportunities, but there are, so we want to make sure these opportunities are shown to others and they can join us in doing this. We will soon have a fund for this equity portfolio, and we share our deal flow in direct investments, co-investments, private equity funds, and venture funds, everything with impact. So our understanding of impact investing, I think, is pretty much in line with what the other speakers have mentioned. We follow very much the tonic or the gin definition of impact. We do want to achieve a market rate return in those respective asset classes, but we want to surely have a social or an ecological impact on top of it, and we want to be able to measure it as much as possible. I mean, it's not always possible, as I'm sure we can discuss in the Q&A, but as much as possible. And also a side note here, I mean, very much in impact investing, people get overexcited with impact measurement. So we stand for a radical approach, just do it. Get started with impact investing. That's my advice to every family that is thinking about it. Now, to kind of come to the conclusion, and I think we want to kind of stop our presentations at 12:30. And this is our investment approach. I think very similar to what Alex showed in the beginning, also what Manish showed. The difference may be we are originally the single family office, so we can be very picky and choosy what we do in our strict negative screening. So, to me, ESG investing is picking the better of the worst in comparison, and we just say, you know, we do not want any fracking, we do not want any speculation with foodstuff, we do not want gambling, tobacco, that's mentioned very often, but we are simply very strict on it. We don't accept certain percentages in turnover in those areas. So we exercise a very strict negative screening process. We then look at the SDGs as our positive screening. So those companies are picked that produce the highest possible positive contribution to the SDGs. And this is kind of our impact investing approach on the listed equities side of things, but also pretty much our approach in direct investments, where we focus on digital, where we focus on food, and where we focus on education, in mainly those three areas. To conclude my little presentation, happy to discuss in the Q&A, you know, can impact be achieved with listed equities by just buying a stock that is listed on the stock market and selling that stock again at some point? I mean, we believe yes, to a certain extent, especially in IPOs, in initial public offerings, in capital increases. So that gives additional capital to those companies. Stock market investments increase the visibility of possibly undervalued impact companies. The whole shareholder activism part of it can change the world, can change those listed corporations and change them towards more positive contributions to the earth and humanity. So I think all of these activities, divest, invest approaches in the listed markets are a very strong signaling effect in the markets, which people like us, but also many people surely in the audience, private investors, family office, can exercise in order to grow the amount of capital that goes into the right direction. So let me conclude here. Thank you very much. Happy to take any questions in the Q&A.
Thank you very much, Peter, for sharing your approach and on one hand very pragmatic, very entrepreneurial, being the single family office of one entrepreneur with a very clear direction, with a very long, actually it's probably the longest negative list I've ever seen in a presentation on investing, but also with a very pragmatic approach, a very proactive approach, and also not being afraid to look at listed equities and see how you can make a difference there. Now we've got a few questions, but before we take questions from the audience, I'd like to come back to this sort of a paradox of on one hand really being very focused on the measuring, and we heard from the outset from Alex Scott on how, you know, from what we can get from various asset managers and professional manager, a very detailed and granular analysis of what the portfolio can do, can impact or not impact. And we heard also from Benjamin on how it's important not to lose your purpose, your passion, your basically entrepreneurial approach. Maybe if I can ask each of you, maybe starting with Alex, and on, you know, when you go through that very granular exercise of aligning the family and concluding with a great statement, and then you have the portfolio on the side. Now, how do you keep the entrepreneurial spirit in all of that of the family? I think your generation 4, generation 5 has taken over. Now, there will be more opportunities. How do you keep that and not just give up sort of the entire investment activities through a mandate?
Yeah, interesting question. I'd start by a perspective which is to say I think it's absolutely fundamental to the long-term coherence of a family group that you are in business in some way. I think it brings a discipline, a focus, a challenge, the highs, the lows, the responsibilities of owning a business are really fundamental, I think, to binding a multi-generational and multi-group together. So what we have done is we have split. So I've been talking to you about our liquid investments, but we also have within our family company, we have an illiquid pool, which we will invest along the same principles that we have been talking about today, in terms of them being impactful and societally beneficial, but we'll be much more closely involved. So if you like, there are two strategies going on there. There's the liquid portfolio, which we choose not to oversee directly ourselves, because we think it's large and complex and requires a huge resource to do it well. And there's the illiquid side, where we're much more likely to be deploying our own assets into businesses in a much more entrepreneurial way. So I think we think thereby that we can get both things. We can be purposeful stewards, and that's our raison d'etre, to do the right thing by the capital that we've inherited, and we want to invest it in the right way. But we can also keep entrepreneurial at the same time, keeping in proportion the risks that are appropriate for a fourth and fifth generation family. By definition, the risk profile of a fifth generation family is different than a first and second generation family. So you have to manage your risk, and you have to manage your asset disposition according to that, which is why we put quite a small proportion into our direct activities. But it's a critical one, and that's where we'll be entrepreneurial.
Thank you. There are a couple of questions, and yes, sorry to, this entrepreneurial question is important, because, you had shared with us on previous occasions that at one time the next gen were saying, but, we want to be entrepreneurs. We want to own and operate assets. And obviously, as we're talking about investment, impact investing, sometimes there's a feeling that, you're a bit remote. I mean, you look at reports on what the impact you have, and you were very clear in, reduction in carbon footprint, social benefits. Yet it's sort of you're quite far away from that impact, I suppose.
Maybe one additional aspect, Alexi, to this question. Often I see that, especially with larger families, that also the concept having a family venture fund to engage, to set up new businesses, can become a very good tool and instrument to keep the entrepreneurial spirit alive. Moulier family is doing that. That's a very prominent example. Al-Zayani in Middle East, Danfoss, Lego, and so on. There are many examples. What is the benefit for this? The benefit from my point of view is that if you do it in a professional way and manner, meaning that next gens who have an idea, business idea, needs to apply for family funding. They have to go through a professional process and having access to family funds. But once they went through the process, then they enjoy the full backing and the support of the family as a group. And this is really setting them up better for success than fighting on their own. And in the current landscape of new companies started, and I think Peter Brock has come up with a very impressive number of direct investments, provides a lot of room for entrepreneurial engagement and activism.
I'd agree. I think it's one of the most exciting times for entrepreneurial activity. The only thing I'd qualify that with, Peter, is that I think you can be a really great inheritor and not being an entrepreneur. There's a tendency merely to value and to lionize the entrepreneurs. Of course, everybody has a founding generation who are extraordinary. Those of us who follow, there may be entrepreneurs amongst us, and it's wonderful if we can back them and be with them on that adventure. But there's absolute dignity and purpose can be discovered from those of us who are not entrepreneurs as well. So finding a construct, as you've just described, where all the talents can coexist and all the talents can be brought together, and in our term, be purposeful stewards. I think that's a critical task, and it takes governance, as Alexi said, and it takes alignment of values, as you said as well.
Thank you. It's about how you capture next gen innovation, next gen talent, into the family and into the business family, if that's what we're talking about here a bit more. Now moving to measurement, and Tom, you're the specialist here. There's a soup out there. There's a soup out there. You know, we heard about gin and tonic from Peter. We heard about B Corp from Ish, and many of us here in the audience are familiar with these concepts. Where are we going to, and how are we going to align? And is it only going to happen via policy and government? And we all hear about this EU taxonomy coming up. Just help us with an helicopter view to understand a bit what's coming out and how you would advise us to approach this.
Yeah, I agree. It's a really tricky one because there's an alphabet soup out there of ideas and initiatives that are all bringing in different perspectives on what to do around measuring impact. I think the first place to start is to recognize that all investments have an impact, both positive and negative. And actually what we're trying to do through focusing around impact is recognizing that those businesses that create more of a positive impact, less of a negative impact, are those that are more likely to succeed. So actually these are just the fundamentals of business growth, but adding a new layer and lens on top of it. So there isn't a right or wrong way about going about thinking about measuring and monitoring impact. I would just say that there is a whole host of different initiatives out there that give you things to sort of borrow from and take the best ideas that work for you. There's a completely different emphasis that's required on a public listed company versus what might be required in a fledgling business or in a venture capital sense. The right scale of investment of sort of metrics that you look around impact around will vary significantly. If you're looking at a very early stage venture, you're probably more interested in the management team, the quality of that management team and how much they are invested in delivering on a positive impact. Whereas if you've got a much more mature business, it's probably got the ability to start looking at degrees of measurement, which are much more sophisticated. And it's finding the right balance for the effort that you're putting in.
Thank you, Benjamin. You want to add a few things, and then Peter, I'll give you the floor.
Yep, thank you.
Yeah, I just want to react to, because I've been doing that for 10 years. I started in my firm as the impact guy and coming from environmental sciences. And 10 years ago, I looked what was around to report on impact. And then we decided to create our own tool. But I think today there's an initiative that is great and that is regrouping most of other initiatives. So I wouldn't say there's such a soup. First, the term measure is not used so much with practitioner. It's impact management now. So you manage your impact. And this project in the UK that started, it's called the Impact Management Project, is a framework. They don't give you your metrics that you will have to use, but they give you a framework. And you can see that the whole sector is now applying this framework. I was checking IRIS. This is for practitioner, but it's one of the biggest initiatives for impact measurement of the GIN, the Global Impact Investing Network. And lately I went on the website and started creating a login, and I saw that they were applying the impact management project methodology. So this is really, I encourage you, the ones who want to learn about impact measurement or impact management, to go on the impact management project website. They have tons of resources, and it's really applying the methodology and explaining this philosophy of, as Alex said, you have avoid harm, or Peter also say, but then you have contribute to solution. Then when you contribute to solution, how do you make sure that you do? And this is the framework is great because it gives you what are you trying to achieve? Who are you targeting? How much of them? And then what does it change in their life that you are here investing? And then at the end, what is the risk that this impact happens or not? So this is a great initiative. After years of seeing terrible things, this is great.
Thank you. Indeed, I think moving from a ticking the box compliance exercise to a management exercise is essential. And we want to encourage that. And we will definitely invite this initiative that we have all heard from, because I think it's important to get there. And as we learned from Alex, it's moving from return to risk to impact. Peter from PwC, you wanted to say a few things, and then I see
just as an addition to my predecessor speakers here. Yes, it's true. There are many different ways how to measure the various categories of impact. I think it's important to understand what is material for my industry. And there is a SASB materiality map. And so you should be aware of what can be influenced by my operating business or through my investments. This is why I see that families coming from a specific sector, whether it's pharmaceutical, automotive, manufacturing, retail, are focused in their impact investing and also philanthropic areas on those areas that they know, that they understand, because then you can have the biggest impact if you have an understanding about the rules of the industries and the like. And the great examples are Barry Callebaut, Jacob's family with the Forever Chocolate initiatives. They picked a clear target, what they want to change in their value chain that they can influence. So it's important, understand what you can influence, understand the materiality for your industry. And the second part, which I feel is also a change in mindset for many family offices and family businesses, this is transparency. Family business are used to disclose not much and stay very private. And in this new world, with the non-financial figures, with the impact measures, you need to become more transparent and to report and hold yourself accountable against clearly defined KPIs, measurable targets. And this kind of transparency is something that many families are just at the beginning to identify that this is important, step out of the shadow and become more transparent.
Thank you very much, Peter. And it's a great way to remind our audience that this is the reason why we have partnered with UNCTAD, and this is why FBN today is a strategic partner of this World Investment Conference, because we are pledging, we have pledged and committed to not only measure our impact, track our progress, but report transparently on it. When you look at our new pledge, and I invite you to go on the joint UNCTAD FBN website, this is the most probably fundamental sentence that we are saying. And for business families who have been private and hidden, as we say in French, vivons cachés, vivons heureux, this is a major exercise. It will take a generation, but we are committed to embark on this, to accelerate the movement and bring our families to tell their stories in a more confident way, in a humble way, because we don't have all the solution, but in a confident way and based on the right data. And I see that as we talk about the alphabet soup of measurement, the debate and the discussion is heating up, and we have Manish, then Peter Brock, and then Benjamin. Manish.
Yeah, thanks, Alexi. No, I just want to add to what Peter said, right? That families remain private, but I just want to share a very grim fact which I read recently. A BCG report came out, I think yesterday or a few days ago, and which mentions that less than 10% of the listed companies actually report their carbon emissions correctly, which means that more than 90% companies themselves are not reporting it correctly. Forget about the data providers and the other things, right? So where are we there then on terms of measurement? Having said that, it's not lost on us. So the way I see it evolving is that how it happened in the accounting profession, right? So the accounting disclosures of the company, if you see 30 years ago versus what they are now, are dramatically different. So the key would be standardization of the matrix across the company so that you can compare one company versus the other, because currently it's very subjective and it's more framework driven rather than a standard driven. So once there are uniform standards and benchmarks, which can be used across various companies, I think it will be a lot more easier decision for investors, whether it is family office, individual investors, or institutional investors, to then they make that conscious decision and actually hold the hand. So it's not to exclude or punish the companies who have not embarked on this journey, rather than to engage with them, right? So as a signatory to net zero asset managers, one of our responsibility is to engage more and more companies which are in the material risk sectors and make sure that their impact is reduced. Because without that, we are not going to move if we leave the last man or the last company standing on this planet. So
thank you, Manish. And we have heard and we've heard publicly recently from PwC actually this major strategic initiative and a major investment just a few months ago in that direction. Not only financial investment, but also attracting talent and resources to tackle this major issue coming up. Peter Brock.
Yeah, very briefly, my view would be a lot of things have been said on measurement. Everything is correct. But my view would be, let's not get bogged down with measurement. Let's get started with good investing as much as you can choose the good investments. As a single family office, we don't want to burden social entrepreneurs or young companies that do good in the world with too much measurement, so you can also overdo it. And let's look at the financial services industry. I mean, after all, if you come with the same stock market portfolio to different banks, you will get different ESG scores if you go to different people, so also the ESG world cannot do the right reporting on a single portfolio. So why should we in impact investing burden ourselves overly to try and get the right figure out of it? So be pragmatic, get on with it, and with some common sense. Sometimes that's good enough for most of the decisions, would be my view.
Thank you, Peter. Benjamin, I'm sure you will probably agree with this view.
Well, on the last point, I think even if you're a small company, I deal with the larger companies, but I think even small companies, even if you're a social entrepreneur, you have to care about how you treat people in your company and your impact. So of course there is sometimes too much metrics, too many, but I think the fundamentals, any company can be sustainable, more sustainable. Then just reacting on what Alex said about entrepreneurs in the family and this, two things. First, millennials, I read in the PwC report, and we hear all the time that because millennials are so concerned that impact investing is the next frontier and etc. But to me, my personal experience in my family is that my dad and my uncle, who are the elders, they are the ones who help me the most, and they are 77, 88. So they care about the state of the world. They see what's going on. So this is not only the next gens that want to do impact investing. And I agree with you, Alex. We're not all entrepreneurs. And as we all, I think a lot of us are concerned, like the elders, like the other ones. Also, as family business members, we have some beliefs and we have some things in us that are, I want to be an entrepreneur like my grandfather, or I want to prove that I can make money. So we are complex, right? And we have those, we struggle with those beliefs that we have. And the other day when this cousin was presenting at our family gathering, he said what touched me, and I saw myself in him. He said, I spent a lot of time on running my company to prove that I could make millions too. And then now my girls are going to college, and I have this kind of regret that I didn't spend time with her. And so this touched me just because also we had a child 2 weeks ago, and I'm struggling with writing emails, preparing conferences, and also being there at home. So it's a story of balance. And we are not all entrepreneurs, but what keeps the family together, I think, like my dad, my uncle with me, is that we work on those problems, as Alex is doing with the rest of his family, that keeps the family together and help to continue and to pass it to the next generation.
Thank you, Benjamin. Peter from PwC. And then we're going to conclude.
Yeah, just one addition. Fully agree, Benjamin. So unfortunately, what we see is that there's still the gap that I mentioned in my previous statement between ambition and core values of a family and action. And we stated in our report that there is a certain risk for family offices and family business to losing their license to operate. They are pool positioned because they are value driven and committed to be around for the long term. They are pool positioned to be a force for good, and they are pool positioned to solve the problems of the future. Nevertheless, since there's so much pressure from international investors on the big listed companies, regulatory environment change, there's a certain risk of falling behind. And we are all here today as friends and strong believers in family offices and legacy family business. It's just a call for action. Treat the topic serious. Find your way to codify your values and act like Alex and the family did, and you obviously also in a good way, Benjamin. So this is my message to the audience. Don't wait. The time is now to act, because there would be a big disaster if in the public opinion, the leaders becoming a force for good will become the big corporate listed corporates and not the family businesses anymore.
Peter, thank you. Thank you so much. On this call for action, it's time to wrap up. Indeed, time is to act now. Indeed, we all know that we are in this transition period and there's a lot of divide. License to operate for anyone, business, academics, politicians, is becoming an issue. And I think this silent economy, which family businesses represent, with 60% of employees, 2/3 of value creation around the world, we know it's time for us to tell our stories, to come out of the closet and to really embark and continue that journey of honesty, of long-term view, and really on finding ways to manage what we deal with on the daily basis, which is the paradox of bringing together the family and the business, bringing together the purpose and the profit. And on this note, I really want to thank this amazing panel coming together to inspire us, to share with us in a very open and transparent way how they are struggling with the issues, but how they're finding ways as small families, medium families, and larger families in terms of number of family members, to have more impact in a more conscious way. Thank you, Benjamin. Thank you, Alex. Thank you, Peter. Thank you, Manish. And thank you, our partners, Peter and Tom at PwC, for continuing to research the question, to inspire us, and to invest in that space so we can be on that journey to leverage business assets and business values to make a difference.